Well, good morning to all of you, and thank you for my trusted partner, Mr. Christoph, for joining today. How are you doing today on this beautiful red down day in the market?
Good morning, boss. I'm excited. I haven't seen such volatility in the VIX in a while, so I don't know whether to grab my helmet or find a bunker. What's going on? Can you tell us what the VIX index is and
Sure.
why it's up 22%?
So before there were all these esoteric products that were out there, such as derivatives and tokenization, the VIX was used by portfolio managers to put portfolio insurance on. And a lot of times they would do this on a daily basis because they had to be hedged, what's called delta neutral at the end of the day. So they effectively had to adjust their portfolio using the VIX so that in overnight action, if there was a spike or a dip, they would have to buy VIX puts and bring the measure of risk to a zero level within their portfolio. So that's how it used to be used.
Mm-hmm. What is I know sometimes there's no correlation between the ticker and what it means, but does VIX actually mean anything? Volatility, right? Volatility
I
index.
mean, volatility index. It's actually constructed off of SPX options. So think about it this way. They're looking out 30 days, and they're looking at all the stock components that make up the SPX, the S&P 500 index, and they're effectively guessing to see what the volatility will be 30 days out. And think of volatility as just the range. What is the top side and downside? And so when you have a day like today where the market is down strongly, the VIX will jump. And that's because it's taking in today's new data prices of all the underlying, the 500 stocks in the S&P 500, which are down today. And it's taking that into account. That's why the VIX is jumping today. Nomenclature around it has been it's the fear index. And that is true.
So is 24% seems like a big jump. Is it?
I'll answer that two different ways. Relative to the most recent environment, we've had VIX suppression going on for well over a year. That's a totally different topic. But normally the VIX in a healthy market is between 19 and 21, actually. And so just like Americans have gotten used to super low interest rates, the market's gotten used to super low VIX. And a 22% jump on the VIX is, I would say, in my experience, it's a pretty big deal for a day where nothing yet is being bombed and no financial institution yet is collapsing.
To ask whether you have any sense what is causing it.
Well, the headline commentary is what's causing is the well telegraphed and expected Iranian response to Israel, and they're talking about that Israel simply is not going to be able to defend itself because it's going to include missiles and drones. And we've talked about this, you and I, and I've talked about this with the members, that one of my doom trades or doom scenarios this year that I put out on January 1st was an expansion of the Middle East conflict. And this would be a significant expansion of the Middle East conflict. You're talking about an additional nation state being brought into the conflict and bombing or attacking actual Israeli soil. That's a big deal. And there typically is a measured response, right? And so Israel takes out the head of Gaza's kids and grandkids. And that's one of the things they did. And that, and a senior leader, and typically there'd be a response to that would be a pinpoint attack on one of the Israeli leaders or family. This is not a measured correlative response. Now, we also don't know if this is all a bunch of psychological warfare too, right? I mean, when you got the British, you got the US, you have all these press agencies out there saying the attack is imminent within the next 48 hours, the next 24 hours. I sort of look at it like, well, doesn't that sort of defeat the whole benefit of surprise? But then you look at the weapons. We're not talking about a ground invasion. We're talking about drones and missiles that are, even with Israel's Iron Dome, will absolutely overwhelm the Iron Dome. And the Iron Dome can't do anything with drones. It only works off of missiles. So,
is it fair to say that oil prices today going up 2% is also correlated with the Middle East, or is that? I mean, is that too obvious a point to make?
No, I think that's spot on. I mean, oil is rising today, absolutely due to the Middle East, because the concern would be, if you look at it this way, so Iran will respond, then Israel has to respond, right? And one of the targets that is a juicy target are Iran's oil making facilities, the refinery capacity, and that would take from the global supply, I forget how many millions of barrels per day. It's significant, and so it's responding now. 2% though for an oil move, in my experience, is a small jump for what's going on in the Middle East. I remember the days where I'm talking about Iraq, I'm talking about even Gaddafi. I mean, you'd see a 10 to 15% jump in oil on the day. So even this response is somewhat muted, which quite frankly to me is surprising. But that might change once bombs start hitting the ground too. There's this belief that the attack is imminent, but it hasn't happened yet. But it certainly was going to open a whole new chapter into that conflict.
Right. Well, since the recent lows in mid-December of 23, oil has more or less gone up, straight up from 67 to 87. So this doesn't decrease the pressure. I think it's important to talk about this to understand why and how oil is related with the bigger topic for today, which is the CPI reading and interest rates. So I think we mentioned briefly last time that obviously if you're paying more for oil, if oil prices rise, the amount of money people are spending on gas and everything oil related goes up. So that's a pressure to the upside for interest rates. Can you talk to us about what you heard and understood and how you interpret the CPI reading earlier this week?
Yeah, I was sort of chuckling with the market response to it because, the CPI misses by 0.1, right? And
in fact, actually, can we define what CPI means?
Sure, it's the consumer price index. So it's the average cost of a basket of consumer products, durable and non-durable goods. And what they're measuring is in different regions, how much the prices of those products have risen. Now, the Fed has monkeyed around with the CPI in terms of what they count and what they don't count. For example, they monkeyed around with the health insurance component of it. And it used to be that, if your premium rose, that would be registered as inflation. Well, now they count it differently.
Right. Well, that's convenient, right? And one additional point, it's pretty obvious, but I think it's worth mentioning. When you read a number like 3.6%, what that's telling you is that compared to prices last year at the same time,
right,
in that category, prices are now 3.6% more expensive. Right.
Correct.
So it's always relative to the previous measure.
Right. And I think the market, you're absolutely right. And I think what the market keyed off of was the trend, right? One of our principles that we use to trade and invest, but they're looking at the trend, and the last 4 reports have come in hot, as they call it. So hot would mean it's coming above. Cool means it comes in below. It wasn't a super hot reading, but traders are keying off of the trend. And really, the market response was almost like a temper tantrum that, oh, crap, now we're not going to get our 6 cuts or our 4 cuts or our 3 cuts. Now we're down to 2 and 1 cut this year. And I've been steadfast since last fall. I've said there's not going to be cuts. I've modified that now and said, well, maybe Biden will be able to force 1. But when you really think about it, let's say the Fed cuts 2.5% or what the market would call 25 basis points. So what? Big deal. I mean, at the end of the day, a 25 basis point cut is not going to help the banks. It's not going to help real estate. And I want to comment on oil. Remember, the real estate industry in America is in related and directly related industries accounts for almost like 70% of the economy. So when oil moves up, you can look forward, right? Because materials for houses, paint, right? The fuel to transport lumber, shingles, you name it, the electric, the cabling in the walls, the PVC pipes. There is almost no product within a house that is not touched by oil. And so that's why it's such a strongly correlated inflationary data point.
Yes. So you mentioned briefly in passing, that a 0.25% rate cut won't help banks. Can you help us unpack how that basic idea? I'm
Sure.
under the impression that higher interest rates in general means banks make more income.
True. We have to look at the legs of the business of traditional banking. Banking makes money from lending. Obviously, those would be personal business loans, construction loans. When they make those loans, they hold that paper, right? They're going to sit there and they're going to collect those interest payments. Okay. The second way they do that is through direct consumer lending. That would be auto loans and credit cards. And once again, a lot of the banks, they'll sell that off, but auto loans, they'll hold that paper too. And then the third area for banks where they made income is the spread between what they can borrow the money at from the treasury versus what they pay out to consumers. So yeah, you would think, higher interest rates, generally speaking, they are going to pass that, for lack of a better phrase, they're going to pass it on to the consumer. But here's the problem. All that paper they own, right? Whether it's mortgages or business loans or auto loans, okay? If you are a bank and you issued loans at, let's say, 5%, okay? And now the interest rate environment is 6%. Well, the value of those 5% loans just went down. There's two assets that a company has: cash flow, right? And then cash or property and equipment, right? So balance sheet and cash flow. And when interest rates rise, it's their value of the paper that they own is dropping. And if you have where that higher is longer, then all that paper that they have been holding, their principal value of those loans is going to continue to drop. Why? Because they all have an end date, right? Time value in those. And it also makes it much more difficult for the paper that they own to refinance too. Okay. Value of your loan dropped, that value of your asset has dropped, and now you want to refinance, and the bank is going to therefore have to take on more risk, right? And typically in commercial real estate, it's 75% loan to value. $100,000 property, you get a $75,000 loan. Now, what happens if that property drops 10%? Well, what's 75% of 90,000? Well, it's less than 75,000, 60, whatever. And so the bank will go to the borrower and say, you got to come up with more cash. We can't do this loan because it's a 75% loan to value. The other thing banks are doing is what's called personal guarantees now. So previously, you could get a loan on a property and it would be entirely based upon the cash flow and the business model of that property. And if it failed, then the bank had to take the property, right? And banks don't like to take properties. It's not their business. Now, when you have this type of environment, they're asking borrowers to come up with more personal guarantees where it's not just the business, but you personally, okay, as the owner, are guaranteeing that debt. Because at the end of the day, the bank is not going to be caught. They're going to make money. They want to protect themselves. So if the asset value is dropping, you can come up with more cash immediately, or you can personally guarantee it, or you're not getting a loan. And so it becomes this vicious negative spiral, right? Where, okay, we can't get the loan. That in itself will probably drop the property value even more. It really becomes sort of ugly. And on the bank side, then they have to kick that into what's called NPL on their balance sheet, which is non-performing loans, right? And that's what banks have gotten away with so far and not being forced to do, because they've been doing what's called workout agreements, where they add months at the end of the loan. But JP Morgan came out this morning with earnings, and one of the market's really keying on, and I agree, is they commented that going forward, their interest income was going to be worse. Well, where does a big bank, we just talked about, where does the majority of their interest income come from? Right? It comes from their book of loans that they have. So if they're saying the interest income going forward is going to be less than expected, then that means they expect those assets to generate less interest, less income, because their cash flows are going to go down, right? So it's not, I think the combination today, look, the market's down 230 points, the ES, right? Or the NQs are down 230. The ES is down, or the S&P 50 points. It's still not what I would call a normal response to the two things we have going on today. Okay. We've got the JP Morgan and the Wells Fargo numbers, and they were bad. And number two, we've got the Middle East. I mean, this market, quite frankly, in my experience, this would be one of those markets where you wake up to a limit down, right? Where they're going to take a cooler for 15 minutes and cut off trading, and we're not seeing that. So I'm not looking at this like, oh, it's the end of the world. However, okay, what I have seen is, specifically in KRE, which is the Regional Bank ETF, went down big on Wednesday. And yesterday, even when it was a green day, KRE barely moved. So what I'm starting to see, I believe is happening, is the market is stubbornly starting to digest the fact that regional banks are struggling. And we're going to see that in the next 2 weeks as they start reporting. So I think the bulls should be ecstatic that the S&P is not down over 100 points, quite frankly.
And regional banks, boss, are different from the mega banks because, as far as I understand, they took on more commercial real estate.
Yes.
And they also, if I'm not mistaken, have a lot of exposure to bonds at low interest rates.
Yes.
And so, correct. And so, which we might want to segue a little bit to talk about the recent bond auction too.
When you look at the majors, right, the too big to fail banks, the JP Morgans, the Wells Fargos, Citis, there was this rule called the Glass-Steagall Act, which prevented banks from doing any business that was speculative, right? They couldn't trade in the market with customer assets. They couldn't do options or derivatives. That was removed. And that's when we saw the beginning of all the problems we have. Okay. And derivatives obviously were the weapon of mass destruction. But regional.
And I'm sorry to put this so, I'm sorry, boss. I'm sorry to put this question so blankly, but is that essentially greed? Like the removal of that?
Yeah, absolutely. Absolutely. A bank's job traditionally has been very simple business, what we talked about, right? You make loans to individuals or businesses or construction or land, okay? Pretty safe business. I mean, when you think about it, okay? You borrow money for the treasury and then you loan that out. And when they got into speculative, and again, you can see how this is all related. Glass-Steagall was removed. Then a massive amount of stimulus was brought into the market post 2008. And this is one of the reasons why I not jokingly, I think Jamie Dimon and JP Morgan, I love hammering them, because those guys sat on Capitol Hill and they said after the 2008 collapse, okay, the stimulus, the bailout money you're giving us, we will use it to loan to small and mid-sized businesses. Okay. They didn't do any of that. Guess what they did? They speculated with it. Regional banks were not able to do that. Okay. So they weren't allowed to speculate. So they had to make income somehow. right? Because when the majors were speculating, they were getting good returns. And so they were able to offer higher interest rates to their customers. Well, regionals are sitting there saying, well, we don't have that ability because our business model is conservative and is what banking used to be. So they were encouraged to really get into the commercial real estate market. And we're not talking straight lending only. We're talking derivatives too. I mean, they got into some of the more esoteric products and they don't understand them. Look, I know regional bank owners and I've sat down with them, and I know a bank here in Colorado that primarily all they did was loan to farmers, right? Safe business. Okay. And they then got into commercial real estate. And it's one of those things, it's a boom and bust cycle. And it's good, it's really good. But right now, there is a tremendous amount of stress in the commercial real estate space. So the regional banks are really sweating it because the other thing, they don't have this massive balance sheet, right? They can't withstand whatever the percentage. They just don't have the financial capability to withstand a severe downturn in the lending market.
Right. And therefore, that's why the trouble with bonds is even more troubling, right? It's a double whammy.
Oh, yeah.
Right?
Well, typically what happens with greed is you forget that you pretty much put risk to the side. It becomes this, oh, we can just always make money. And what that does is it increases the amount of risk that you take on. I don't care if you're a bank or a person, right? This is human behavior. When the going's good, you want to get as much as you can. Nobody ever points to when the party ends, what problems are you going to have? Because everyone believes, I'll have time to adjust to that. None of them do.
Right. That's why you're the fun guy at the party.
Oh yeah. People love talking to me because when they walk away from it, they're like, well, great, you just blew the party atmosphere. Now I want to go outside and hit myself in the head.
Right. So if I think back to Silicon Valley Bank, I mean, in this naive way of understanding, bonds are usually advertised as safe, right? A safe or safer asset.
Absolutely.
So isn't that what happened in part when interest rates were low? Banks loaded up on bonds because, quote unquote, they're safe. But now we have rising interest rates, therefore plummeting bond values that are not being realized at the market price, correct?
Correct.
And so that's the double whammy that regional banks are facing, right?
Yeah, and Silicon Valley Bank, people look at it like an outlier. It wasn't an outlier because what Silicon Valley was doing, they compounded the problem because they were lending money to startup companies that had no revenue. Okay, I mean, where's your collateral, right? And what caused Silicon Bank to fail was a deposit run, people came in and they demanded their money out, but it wasn't. I mean, it was large institutionals, right? Saying, hey, we're concerned based upon your lending. We're concerned that if you do go into FDIC, we won't be able to get our money out for months, right? And so that's why Silicon Valley Bank failed. And that's why whenever you hear of a bank, and it started with New York Community Bank this past, a month and a half ago, where you were starting to see pictures of lines forming out of New York Community Bank branches. That's a deposit run. And that is what the market is terrified of any of these banks getting hit with a deposit run, right? Because people get nervous and they say, I better go get my money out right now, So
if you're an investor right now looking at the ticker symbol that we talked about, KRE, which is an index of small regional banks, for every seller, there's a buyer. Who's buying these right now, and why would they be buying them?
Well, I think it's important to remember that over 90% of the volume in the market is algorithmic, right? Whether it's high frequency traders. So yes, there is a buyer for every seller, but that buyer may be turning around and selling it immediately. Okay. There's a difference between a buyer that we think of from the traditional term of an investor, where they're buying to hold it. Okay. Well, with the volume in the market, being over 90% algorithmic, they have no intention of holding it, right? So they're just taking in the liquidity, they're taking in the sells, right? They're buying it, and they may turn around and immediately sell it. And that's why you can have that type of price action, and yet there is a buyer for every seller.
Right. So is this what the term natural buyer comes in? Like to imply like a human thinking this is a good bet for the long term versus algorithmic stuff?
I would say traditional, but I like the word natural too. Yeah,
Okay.
as you and I've talked, the traditional / natural buyer is the flea on the tail of the dog. Okay, I mean they're getting whipped around by the algorithms.
Okay, so let's return to or segue, if you're okay with it, to the recent bond auction. From what I've read, the analysis I've read, it's either between not great or pretty dismal. And what does it suggest in the big picture? How does the bond auction tie into all this stuff about the CPI coming in a little hotter, oil going up, and the war in the Middle East?
Sure. So a bond auction is when the U.S. Treasury is offering bonds to refinance their debt, right? And we just had two bond auctions this week. I think it was a 2 and a 30, but I know the 30 was the ugliest bond auction on record. And what made it ugly was twofold. So the Treasury will issue what interest rate that they're going to sell that debt at, okay? And if they don't have enough takers, they'll incrementally move that rate up. Well, they had to do that. But the second part of it was they had significantly less bidders for the debt. I mean, it was the worst on record. Why would that be? Well, if you're buying Treasury debt, okay, and you believe interest rates are going to go up, again, why would you buy it today? Because if interest rates go up tomorrow, your bond that you bought, okay, is worth less. So it's entirely, they're more concerned about getting their principal back, okay, in whole, 100 for 100. And that's why we saw such a terrible bond auction. I think what also is super important is, and I don't know if it was a zero bid, but foreign buyers of that auction were almost non-existent. And we know that other than the U.S. public that holds, greater than half of the Treasury debt, it's foreign buyers, foreign countries that are buying U.S. debt. And if they turn off the spigots, guess what's going to happen at the next bond auction? They're going to have to raise the rate even more. And so again, it becomes this just nasty cycle where, okay, we didn't have enough bids, we'll raise the interest rates. The buyers say, we'll stand aside because we think you're going to raise them again. And then the Treasury says, well, we got to raise them a little bit more. And it just becomes this just terrible cycle. And that's inflation. That's the effect of inflation.
Right. So that's another data point. If what we're doing here is trying to be reasonable and collecting data points, it's yet another data point that inflation is higher than the talking heads, higher, stickier, right? And that the data is actually pointing in the direction that the rate cuts ain't coming anytime soon, or certainly not in the promised amounts that we heard when the market got all hyped up in late November. Is that how you read the situation at the moment?
I do, and I want to make a comment about CPI. So while there's CPI consumer prices, so CPI consumer price index, and then there's the PPI, which is the producer price index, and I prefer the PPI because that's actually the companies that are making the product, how much more they're paying for materials and labor costs and all that. And if there's an increase there, they're going to pass it on to the consumer, right? There is a term that is used called it's called supercore, and supercore inflation is non-housing. Okay, and so that would be lodging, house prices, rent, food. But what it's 50% of it is made up of labor. So One of the things that the
I'm sorry, boss. I'm sorry to interrupt. Can I just ask for clarification? You're saying supercore inflation takes out housing from its
yes,
calculation. Is that correct? Okay.
that is correct. Supercore
Okay.
inflation takes out housing, but it's focused on labor. And one of the things we know is that the Fed, in all their genius, is focused on what they call a tight labor market. Tight labor market is employers have to pay more wages, right? And or they're having a hard time hiring. And that supercore inflation, wage growth, that's what the Fed, although they haven't stated it, I mean, they'll talk about it, but that's really what the Fed is looking at, because such a sizable chunk of that supercore is made up of the labor market. You know, as a side note, I find it humorous when people listen to the Fed and the Fed says it's a tight labor market and we need to fix that. What they're talking about is we need employees to be paid less and there to be less jobs available.
Mm-hmm.
So if there was ever a question of, is the Fed exist for your benefit? It does not. It exists for the benefit of the banks, the large banks that manage it and head it. So can you tell me why 2% inflation target is a magic number? What is it about 2%?
That always seemed random to me, but I'm not an economist, so I'm pulling my ideas here don't count for much. But the best guess I would have is that 2% is somehow, relatively speaking, close enough to zero that the effect of it is it's like drowning by water drops, that you can't really feel it.
Mm.
And it's because it's above zero, it allows for enough capital in the system to kind of lubricate capital and business. So some balancing act between not noticeable
Mm-hmm.
enough, but there.
Mm-hmm.
But to your question, why two and not 2.5 or four, or whatever? I have no ideas.
Yeah, because there's been some chatter that the Fed will actually move the dot, right? They'll say, well, we said 2%, but now 2.5% is acceptable. I saw numbers high as 3%. If they do that, the market's going to go down a lot harder than it's going down today. That's a big deal, because effectively that would be the Fed saying, we're okay, and this is how it'll be printed in the press. We're okay with a 50% increase in our 2% number. Well, it's to 3% is 50%, but it's not a 50% increase up to 50%, inflation. But that's that fun with numbers that, the press likes to use. But yeah, that would be a big deal, because think of the added, well, two things, what we were just talking about. Think of the destruction in value of all those loan portfolios, right? If the Fed is now saying we're okay with 3% or 2.5%, I don't think that will happen until after the election. I think that's when they're going to readjust, and they're going to be forced to. Okay. I do not think this inflation move higher is temporary. Okay. When they talk about inflation higher for longer, they're saying higher for longer means, they're talking in months. Okay. I'm talking in years, right?
And right, to be clear, you're saying that not only the current number will be higher, meaning the cost of capital will be higher for longer
Mm-hmm.
in the momentary rate, but you're also suggesting that the base goal will move up
Higher.
from something like 2 to 3.
Yes.
So higher for longer in 2 dimensions.
Yeah. It would be sort of, like the Fed admitting failure if they were to do that. But I don't see how they get out of doing that if inflation continues to track upward, because when they talk about that inflation, they're not, the audience is not us. The audience are all the foreign countries that are buying the debt. Okay. And what they're telegraphing to them is, hey, we're going to be okay if inflation stays at 3%. So don't expect us to use any tools to try to move it down lower. Because on the inverse, if they are able to move it down lower, then those bonds that people bought at, let's say 5% are now worth more money, right? Because what you could buy today is going to get less interest. So that's why interest rates are such a big deal to the stock market.
So that's a lot of high level stuff, right? What do you think is the summary takeaway from everything we've said for any investors that might be listening and discovering this podcast and in your Discord for the first time? Like, what's actionable about any of this?
I think this is a time period. Let's ignore the movement of the stock market, okay? And we look at it just from traditional business model, right? If as a business, you're going to have to pay more in labor cost and or borrowing costs, you are going to have to pass that along. And so I would say from an actionable standpoint is be prepared for your food, your fuel, your clothes, for them to continue to increase how much they cost. From a trading perspective, this is not in an environment where you want to be aggressive because, and especially to the long side, I firmly believe that artificial intelligence, the AI boom in the market, saved the market from correcting this past fall. Okay, if it wasn't for AI dragging everything else up, this market would have corrected. But I think if you are a consumer, all you need to do, you can ignore the numbers and look at your grocery bill, look at your fuel bill, look at your electricity, your utility costs, right? Also, look at your property taxes, because as a city, right, they have to buy materials, pay labor, right? They have to borrow money. If their costs are going up, well, one of the largest components of their income are property taxes. And so property taxes also across the board are moving up. Look at your property insurance, right? Look at your homeowners, your renters. Look at your health insurance if you pay it. And even if you don't pay, look how much is being taken out of your paycheck. And so all these costs are driven up. So when somebody says to me, or when I see a report that says, well, the inflation problem is fixed. He said that like 3 months ago. You sit there and you're reading, you go, well, no, because the dollar menu at McDonald's is no longer the dollar menu, right? I'm paying more for everything. So inflation is absolutely higher than the Fed wants it. And there's a reason why the Fed and Washington doesn't get it. It has to do with they live in a bubble. These guys do not do their own grocery shopping, okay? These guys do not pay for their own meals. A lot of them don't even pay for vehicles. They don't pay for insurance. They don't pay for housing. It's provided to them. So they don't understand it because they're not living as the average person does. I think part of that is what's going on, but I also think there's a willful ignorance too, right? Especially with the party in power right now. They don't want to admit that inflation is higher, okay? I just saw the press secretary for POTUS blame inflation on COVID and Russia. And, I had to sit there and laugh, and I thought, you got to be kidding me. I don't know what products are produced out of Russia, but I'm pretty sure they're not allowed to be imported here. So, and it's not like Russia's a great manufacturing country like China would be. So look at your grocery bill. Okay, look at what you're paying for everyday items. And until you see that number start coming down, guess what? Inflation is occurring. They keep going up.
Yeah, this wasn't on the original agenda for our conversation, boss, but I thought it's maybe timely to ask. If I ever tune into, I don't know, the negative label is Bitcoin maxis, and I know any views, on the extreme need to be taken with a lot of barrels of salt. But so maybe even forget Bitcoin maxis. Somebody who advocates strongly for Bitcoin as call it safer alternative to this kind of system. And, I read their messages and it's kind of like, get in before it's too late, right? Get in before the system collapses. Get in because this death spiral is inevitable, so on and so forth. Do you find any? Do you find that at all convincing?
No. Structurally funny because Bitcoin advocates will talk about how it's a replacement and it's so much better than fiat currency. And the argument against fiat currency is it's not backed by any real asset, right? Well, please tell me
Right,
what Bitcoin's backed by.
yeah.
What's Bitcoin backed by? What real asset? None.
Well, let's see. Let me think this through. So let's see. I think in those terms, fiat, the mock against fiat is that it's at the will of the government. You can't, so they could continue printing and basically taxing you without your permission, right? At their will. And so therefore, it's unlimited and susceptible to human greed and overextension, right? That you print more than is actually needed. So another way I understand this is instead of asking people to have more discipline and undergo a little bit of austerity, hold back so that we could balance things. Instead, the impulse is to just print more money, and eventually, right, that comes back to bite you in the ass. Bitcoin, as far as I understand, the difference is that if I'm thinking about this right, is that it's a form of money, and money by nature is it's a story. There is no there. It only works because we say it works, right? Same thing with gold or anything, tulips, seashells, right? But the difference being that Bitcoin has a hard limit to it's non-inflationary, so there's the scarcity bit of it, and because we already believe in it or believe it in enough, right? It's $1 trillion asset at this point. That since it can't be inflated and it's available to everyone and we already believe in it to some extent, that acts as a kind of, it's different from fiat. Yeah, maybe because of the scarcity, you can't make more of it.
Okay. So let me comment on that. Number one, in order for something to be used as a currency, it has to be readily usable and it has to be accepted to transact business. Bitcoin is not used to transact business. Okay, number two.
Right. So it's not a currency, right? It's more like it's like gold.
It's digital gold.
Digital gold.
Yeah.
Digital gold, right.
A quick story. I remember one of the meetings I went to and I was talking about gold, and gentleman, one of my business partners was sitting there and he had a gold Rolex on. And I said, well, gold is a store of value. You can use it to trade. He goes, okay, let's wait. The waiter came and the bill came and he said, here, I'm going to give you my Rolex watch to pay for the bill. And the guy said, you can't do that. He said, what do you mean you can't do that? It has value. And the waiter said, what are we supposed to do with that? And that's always been my argument on gold is like, what are you going to do in the event of an apocalypse? You're going to shave off a little piece of gold, right? But on Bitcoin, the interesting thing, and I'm comment what you said, if Bitcoin price it doubles from here, okay, and you own it, I believe you would have the temptation to actually spend more money because you have more money because your Bitcoin has gone up. So I believe actually Bitcoin, that the price increase could cause, if it becomes widely accepted to barter with, to trade with, will cause inflation. Because while there's not more of a supply, the absolute value of it in the market has grown. And so if you have more of it in your bank account, I believe you will spend more money. So I think actually Bitcoin's price increase is inflationary.
So did we actually, did we answer my initial question of the thinking of Bitcoin as a strategic insurance bet against the fiat currency crisis? Does that answer it completely?
I don't know, because I don't accept that Bitcoin is not a fiat currency. Because
the ETF now, or
you can't trade with it. Just Bitcoin. You can't trade with Bitcoin. I mean, yeah, there's a couple of vending machines down in whatever Argentina or whatever, Brazil. But can you go to McDonald's right now or the grocery store and pay in Bitcoin.
Right. So we're back to that initial point where it's not a currency, but like gold, it's a store of value, or that's its intended purpose. And people advocating Bitcoin in this moment are saying, well, the value of your dollar is at the mercy of governments you can't trust. So you might as well put your faith in something that can't be manipulated. And between the two systems available, Bitcoin is the more reasonable one at this stage of human civilization.
Yeah, I don't subscribe to that view. I don't subscribe to Bitcoin as being the next that is going to replace fiat currency.
The Bitcoin people, as far as I could tell, I mean, who knows? Maybe there are some, but I don't think the Bitcoin people that I'm wondering about are saying that. They're saying, given that that's true, that's not going to replace currency. It's still the better insurance, like gold. If you know one system is falling apart, then at least the other system might have more internal integrity, and that's where you would want to position yourself.
Yeah, but if you have Bitcoin and you want to use it, you have to convert it to fiat currency. Well, while you may not absorb 100% of all the bad issues with fiat currency, you're going to experience some of it, right? So I know what the perfect dream scenario is for digital currency. I get that, right? But as we look at, even with all the altcoins, what the altcoins are focused on, the majority of them, I'm talking about, legitimate ones, right? They're focusing on the actual structure and what it can be used for, whether it's medical records or, the security part of it, right? You cannot put a value on digital currency other than it's truly driven by buying and selling. It's perceived value. No, it's not set by the central banks, but it is set by a large group of holders on what their perceived value is. And I'm just saying that some of the things of the use of digital currency that supports part of that argument of having a value, I don't agree with it. And I'm trying to make the point that, hey, Bitcoin goes up, it's going to cause you to spend more, not spend less. And that's going to drive inflation again.
Right. The systems are, I think, forever intertwined. We can't, there's no perfect system. There's no perfect solution. Everything's interrelated.
Yeah, and I'm a guy who's been saying, look, I absolutely think Bitcoin's going to be over $100,000 at some point this summer. But that's entirely driven by supply and demand. It's driven by all the ETFs that are being launched and this mad dash for Bitcoin assets. But make no mistake, JP Morgan and BlackRock and these guys are not doing Bitcoin ETFs because they think it's going to end up being a alternative currency. They're doing it because they're seeing the same thing we see, which is, well, there's a tremendous demand and the supply is limited. So therefore the price will go up. But they're not believers and acolytes in the Bitcoin camp, and I think there's this incorrect takeaway that, oh, wow, they're in it now, so they're just validating it. What I'm saying is, oh, no, all you did is you let the worst actors into, the very actors who support and help create the fiat currency, you just let them in. Terrible idea.
Yeah. It's a messy world out there, boss. So I think, boy, we covered a lot of different topics. I think we covered quite a lot. I think we clarified a bunch of points for people, and I think it would be useful to encourage questions. Okay. So for anyone listening, I think we're assuming different levels of familiarity with finance and with markets, and there's, I think, as Mr. Not Advice always says, there's no such thing as a dumb question. And a lot of times that's what prohibits people from becoming investors, from learning how to trade, is because it just seems too overwhelming. So regardless of where you are on the stratum, hopefully today's conversation cleared up some things. And if it didn't, if there's things that remain confusing, please ask us. Join the Discord, go to mrnotadvice.com. There you will find all the links to his membership site, and ask away. And hopefully, if you ask a question, we'll tackle it on a future episode.
The other thing you can do is you can send an email to podcast@mrnotadvice.com with any questions. And Christoph and I will, review the questions. And if we find one that is pertinent to the topic of the day, we'll absolutely give you our opinion on it. I want to continue to encourage people to check out Christoph's work at 7investing.com, and his partner, Luke, who is on Twitter. And he's been doing a great series, by the way, where he's going over a pick a day and really reviewing his stock picks. And he's truly one of the few people I know that when it comes to fundamental analysis, that guy digs deep. So I would encourage you. It's good to have exposure to different styles of investing and trading. It really is. There's no one perfect way to do it. So please check out Christoph's work. He's got other podcasts that he does with Luke.
Yeah, the easiest place to find us is wallstreetwildlife.com, and there you have all the links to the podcast and the Instagram and YouTube.
Are you on? So the two. Are you also on OnlyFans, you two, or?
How do you think I make a living, boss? When I say I'm teaching, I'm teaching very specific skill sets.
Okay, because I still haven't gotten the discount coupon for that, so I would really like your discount coupon to your OnlyFans account. So, I mean, if you really want to know what's going on in the world, you need to subscribe to Christoph's OnlyFans.
Right there you go. That's how we end today's conversation. Yeah.
Okay.
Awesome. All right, boss. It was great talking to you, and let's see what happens in the market next week.
All right. Thank you, sir. Have a good day.
You too.